Round and Search. True traders react to the market.
Hi guys, this is Kelvin here from Round and Search. So today we're going to talk about risk management. A lot of people in the market, they always think the first thing to do in the stock market is know what stock to select or know what stock to invest in. Which, from my trading experience, I find this is not the right way, because the first thing that you need to know is managing your risk. I always say, if you are able to manage your risk, you will be able to manage your emotional, and that will actually help you to generate a consistent return from the stock market. That is the key. So before we start to look into how risk management are able to help you to make a consistent profit from the stock market, I have two questions here I want to ask you guys. So question number one, you have to choose between these two. A, to get 900 ringgit of profit, or B, have a 90% chance of winning 1000 ringgit right now. And the second question will be A, losing 900 ringgit now, or B, take a 90% chance of losing 1000 ringgit. So you can write down the answer right now, and we are going to share you the answer later on at the end of this video. So stay tuned to it. So before we start, please help us to subscribe to our YouTube channel and like our Facebook page. For any new videos that we are coming up, you will get the first notification. And of course, if you find that our video is helpful, do share it to your trading buddies, friends and family as well. And of course, if any one of you want to open a trading account to trade Malaysia stock market, do look into the description below. There's a link there so you can do an account opening online. So through my trading experience and also training to some of my members, I find that a lot of people in the market are not using a proper way to manage their risk. Most of the time, they are focusing too much on profit. So when they have the urge to jump into a trade, they find that they are fear of losing out some of these trades. So that's why they just ignore the risk management and also overexpose their risk into each of the trades. So I'm going to share with you the 3 ways to look into how to manage your risk from macro point of view to a micro point of view. So the first thing will be, how much are you going to deposit into your trading account? Because they find that FD rate is actually relatively low, they find that the stock market can actually generate higher return. But they forgot one thing, is that stock market have higher risk. So when they jump into it, of course, the first time when they make profit, they find it's easy to make profit in the stock market, and the stock market is a way to make fast money, and that is where they gone wrong. And they start to put in more capital into their trading account, and when they start to lose, they lose a lot of money. So that is the thing here. The first thing is deposit the amount that you can afford to lose, instead of putting everything in. Let's say, for example, you have 100,000 of savings. You are thinking of investing into the stock market. Probably within the 100,000, okay, 20,000 that is taking out from the saving into the stock market, you find that, well, it's fine. If let's say I lose the 20,000, I'm still okay with it. I still have 80,000. Or maybe if let's say you lose 50% of it, at least you still have 10,000 with you. So losing 10,000 means nothing much to you. But if let's say you have 100,000 and you are putting 100,000 in or 50,000 in, then you might have a problem, because when you put more or full of your saving into it, you start to feel that you must make the profit. And that is where the gambler's effect comes in, because you can only win, you cannot lose. Because if you lose, all of your saving will be gone. That's why don't overexpose your risk and start from the capital that you want to invest in. Of course, if let's say you have only 1,000 or 2,000, then you should actually put that into saving. Long-term investment, I mean, which means that every month you can just put in or buy some of the blue chip stock or high growth stock or consistent growth stock, then you can to invest in bit by bit. Yes, of course, you will find that it's a bit expensive for that kind of stocks. But if let's say every month you put in 1,000 and 1 year down the road you have 12,000, and if let's say the price is moving up higher, let's say 20% or 30%, you are making a few thousand ringgit from that. So you can look into this, okay, in the form of savings. If let's say you have a lot more money, then you have no idea how to select the right stock, you just hear and buy, or you have just purely the first time enter into the stock market, then you should look into this risk. You shouldn't expose yourself with too much of risk. Second thing will be setting the amount that you can afford to lose for each trade. So for myself, usually what I did was I will have, let's say, my total capital, I will multiply by 0.4. Why I do this is because I want each of my trade that goes down is only 0.4% of my total capital. Okay, this means that let's say I have 100,000, I will multiply by 0.4. And that amount, let's say looking at this, about 40,000. So 40,000 doesn't mean the value of 40,000 ringgit. It is the 40,000 unit. I'm looking at unit. This is position sizing. Each of the stock, regardless of what price amount, I will enter 40,000 unit. So 40,000 unit is equal to about 400 lot. So 400 small lot, each time when the price goes down 1 bit, then I will lose 400 ringgit only. So looking at this, 1 bit 400 ringgit, if let's say it goes down to 2 bits 800, 5 is about 2,000. If let's say your monthly income is about 10k or maybe 20k, then the 2,000 is not much to you. Of course, I'm talking about this is if let's say your capital is 100,000. If let's say you have a lower income, then you should actually adjust to the point that each of the trade that you lose for each price level goes down, it doesn't affect you too much. I have an example here. You can have a look into it. Our investment capital is 20,000. So 20,000 over here, let's say we are buying two stocks, stock ABC and stock DEF. Each of the price ABC is at 0.8 cents right now, and also DEF will be 1 ringgit and 23 cents. So the price changes here for ABC is down 5 cents, half cent, and DEF is down 1 cent. So with the position sizing that I'm using, that 0.4% multiplied by 20,000, it will be 80 lot times 100 units, so which is 8,000 units. So each time when the price goes down, I'm only losing 40 ringgit. And for DEF, because it's 1 ringgit and above, so one price change will be 0.01 cents, then that will be 80 ringgit. Assuming you have 20,000, your income is about like 5,000, 6,000, then this 40 ringgit is not much to you. Even with the price that goes down 10 bits, you are still only losing 800. So it doesn't take a big portion of your monthly income. Then you have less stress into it. Then you will not stick your face into the screen the whole day looking at the chart, or maybe looking at the price blinking here and there without knowing what is going on. Probably a lot of you looking at the screen is because applying the hope analysis, that hoping that the price that don't goes down too much. So this is one of the way to cut off your emotional trade and reduce your risk in trading as well. Third one, risk and reward of each trade. So risk and reward, this one really depends on the market that you are trading in. If let's say we are trading into a market that the fluctuation is low, then you can't expect reward that is too high. Like maybe you can't expect a 1 to 10 of reward, risking 1 ringgit for 10 ringgit, or you can't expect like risking 1 ringgit for 100 ringgit reward. Let's just do a very simple one here. We don't put into the market volatility into the case yet, okay? And of course, we need to look at the analysis that you are using. How well are you understand the market here? Looking at this, just an example, putting at the risk, taking 1 ringgit of risk and your reward is 3 ringgit. And if you enter 10 trades here, without knowing what stock to select, but within 1 year, you make 10 trades. These 10 trades, only 3 trades that you are able to make profit. So 3 trades that you are able to make profit is per trade is 3 ringgit. So from here, you make 9 ringgit. But you lose 7 times in the trade. From there, you're losing 7 ringgit. So at the end of the day, you are still making a profit of 2 ringgit, which is 20%, without knowing, having the knowledge of what stocks to select. Of course, this is just an example to share with you guys why risk management is important and how to handle your risk, manage your risk, what is the lowest point for your risk. I'm sharing to you, if you have the risk management, then without knowing what stock to select, you should be able to make some reward from there. Of course, we have to take into account of how well do you understand the market, especially the volatility, and also how does the market works. So if let's say the market change, then it doesn't have that high volatility and you're still expecting like 3 times of the return from there, then it's not going to work. So first thing, of course, the analysis side will be one part of it, but the risk management is important for you guys to learn and also execute this. So start from what I shared to you guys, start from how much you deposit into a trading account, and then the position sizing for each trade, how much you are willing to lose, and then up until the end, the risk and reward. So of course, that is mainly understand yourself first. First thing, you need to understand yourself. Second thing will be understand the market, which is our enemy. Alright, so if you want to know more about how to understand the market, we have our operator analysis, and for those of you who have been following us for a very long time, you should know how we apply this into the stock market. And you can see, if you saw it in our website, the return for our RNS portfolio consistently beating the market. Okay, so you can check it out in our website here. So come back to the psychology test. So what is the answer from here? So the first question was to get 900 ringgit right now or take a 90% chance of winning 1000 ringgit. If the above, you choose A. You are actually a risk-averse investor. You rather take the profit now than risk the 10% of the chances of losing or profit. And the second question is A. Losing 900 ringgit now, or B. Take a 90% chance of losing 1000 ringgit. So in this point, if you choose B in the question above, you are an aggressive investor. You are willing to take the 10% chance to not lose the 900 ringgit. So from here, if the first question you are choosing A, and the second question you choose B. So you might be confused. Am I risk averse or am I aggressive investor? So here's the thing that I want to share with you guys. Usually when an investor, or every one of us, a human, when we are having a profit, it's easier for us to take the profit at that point. Look back into your trading history or recall back your memory of how you did a trade last time. When the market is bad, the market is going down, it's easier for you to exit for those stocks that you are making profit. But for those stocks that you are losing, you will still continue to hold on to it. Probably you hold for 1 year up until now, you're still having those stocks in your portfolio. Because when you're losing, you tend to gamble. Okay, you might have that kind of thinking of, okay, since right now I've already lose the money, so why not I just wait? Okay, wait for it to hit back, or I get a break even at least, then I can lose lesser. If let's say making profit, you just cut it right now. Okay, you just take it the profit right now. So that's the thing that is not consistent in all the investors, because sometimes they are risk averse, sometimes they are aggressive. So that's why this is a bit of emotional trading over here. So why a lot of people keep on holding on to the losses? Main reason is because they actually invested more than what they can afford into the market. That's why they have this painful experience that they cannot do a cut loss. So I hope today the video able to help every one of you in the stock market, especially for the beginners. I know a lot of you in the market, you have started trading since last year during the pandemic time. A lot of people have jumped into it, make some profit, and also losing the profit at the end of the year. So right now, many of you has been asking what stock to select. I see even from the newspaper, people are asking, what stock should I select? How do I select the right stock? No, okay? Because I find that through my experience, it's not what stock to invest in. You should ask, what are your risks, and also how much can you afford to lose? You need to have a right risk management. If you do a right risk management, even with a probability of 30% of stock selection, you should be able to make a little bit of profit from the stock market. Okay, this is the sharing that I want to share with you guys here, because I've gone through this. I don't want any one of you, the beginners in the market, are repeating this in the market as well. So risk is what we protect ourselves, because we are not the market. So you shouldn't rely on the market to protect you. No one in the market are able to protect you, even any of the regulation, but we ourselves are able to protect ourselves. We need to know our risk, and we need to know how to manage it. If you know how to manage your risk, you know how to manage your emotional in trading.